G'day everyone, welcome back to another episode of the Australian Property Investment Podcast. I'm your host, Aaron Christie David, and I run a mortgage broking business called Atelier Wealth, and we specialise in helping investors start out and scale up their property portfolios. And as part of that journey, when you're scaling up, you may hit maybe the crosshairs, which is maybe I've run out of equity, maybe I've run out of borrowing capacity. Quite often what we're saying is you need someone in your corner who can then see those blind spots before you get there. Today's guest, when I talk about being best in breed, I'm going to say goes beyond that and is a thought leader who's always sought out for not only insights and commentary, but also as an industry advocate. And that's what I think sets Anna apart from a lot of other people in this space. Which is really trying to advance the profile of buyers agencies and what you stand for. Because I'm going to say that you were really at the start of that movement, which is the buyers agency proposition and I guess how you're positioning the market for clients to then come to you to help alleviate that stress point, which is how do I buy property? So without any further ado, I want to welcome Anna Porter from Suburbanite. G'day.
Thank you very much for having me.
Look, we get some wonderful guests coming through. I'm really, really privileged that we've had some wonderful names in real estate, property and finance, but to have you on board, I want to say, first of all, thank you very much. It's a testament that you put your hand up, whether it's, I'm going to say Channel 7 or whether it's our podcast, for example. You want to share your knowledge and that says a lot about you and your business ethos as well. So thank you.
Yeah, no, you're welcome. And you're correct. I remember when I started the property investment buyers agent business, people used to say to me, is that a real thing? Do people pay you for that? But people can do it themselves, right?
Exactly.
Yeah, they can. But, there's mistakes can be made and all that sort of thing. And, there wasn't even a buyer's agent course. So you'd ring Fair Trading and they'd say, oh, I don't know, do you need a license for that? And I don't know, you're telling me. Yeah. So it's come a long way.
Has come a long way. And when you say it's come a long way, it's welcome because it raises the bar, for example, because like our industry, like buyer's agents, very politely, the barriers to entry are quite low.
Very low, too low.
Absolutely, right? We welcome minimum standards. We want professional development. We want a body that manages issues but also raises the professionalism. And I commend you for the work that you've done in your industry as well.
I appreciate that.
Well done. Perfect. Before we do kick off, and I know I've read your bios a little bit about your family, but what I call the 3 Ps, a little about yourself personally, a bit about yourself professionally, and a bit about your own property journey if you want to share with us.
Yeah, love to. So professionally, I started as a valuer.
Yeah.
As a valuer. Oh, I've been in the industry.
You don't have to give away. Don't have to give away.
Nearly
tenure.
Nearly 20 years. So I started when I was 12.
Exactly right.
Keep telling people that, no one believes me. But I was a valuer for a long time. Worked for some of the big firms. Did a lot of the typical valuation work from bank to mortgage to, government type stuff and specialised stuff. Loved it, but decided that there were a lot of people out there that weren't getting guidance or assistance when they were investing. Right. And, often I get asked from friends and family, you're the valuer, you can help such and such buy a property or, know where to invest. There was the model of off the plan, but for me, that just seems a little bit like there's a conflict of interest. You can't act for the seller or the vendor, which would be the developer, and also act for the buyer in both their best interests, I believe. So I wanted to start a business. I didn't really want to start a business. I just wanted to help people, and then a business kind of came. I remember I had, so this is where it becomes a bit personal, I had a little baby and I was pregnant with my second, and I decided to charge a little bit of money for what I was doing, and I was teaching at TAFE, teaching in the valuation course part-time, and helped a few people, and then suddenly more and more came, and then I hired someone, and within 6 months I had 3 people working out of my family room. Unreal. And 2 kids running around.
I was just about to say, you got the people that are working for you, but most importantly, you got 2 little children that probably want your attention as well.
2 under 2, yeah. It was probably one of the hardest times of my life, actually, just in terms of being stretched and too thinly stretched. But I had some great people coming on board as employees, and then I decided when the 3rd person was starting, I thought I really better get an office now because this is getting a bit ridiculous. Yeah. So we went out and got an office, and then that's when the journey really began as a real sort of more grown up kind of business. But that's sort of a nutshell of that. But a little bit about my property journey. So I bought my first property when I was, pretty much straight out of school. I think I was about 19 or 20, something like that. Yeah. And I do remember my friends would go out on weekends partying
Yeah.
and I'd always be the designated driver because I was always broke because I was paying this mortgage. So I was like, I'll have 2 light beers, I'll have some hot chips, and I'll pay my mortgage this month. I'll just keep paying my mortgage. So I did it the hard way. I bought a place in Sydney in the Sutherland Shire, and that's not cheap. It was only a little unit, but it wasn't cheap, and I was on a single wage.
You're in the market, right? Yeah.
I was in the market, and I borrowed 105% to get it. That's when you could get all the stamp duty exemptions, and I'm pretty sure I got the money. I got a little bit of money for the equity as a parent guarantor. So I was really, really committed to trying to pay that down. And I ended up, I was in a relationship, I was engaged to be married, and then we split, so then I was carrying this mortgage on my own as well. And it was all, it was all a bit hard. And I probably, if I'd known more about investing back then, I was just doing the valuation course, so I thought I knew everything. I probably could have done it an easier way than having a mortgage that was probably a little overcommitted for me at the time. And it really affected my ability to enjoy my lifestyle. So, now I talk to people about doing that, but with an investment to start you off if you can't have that big mortgage. You don't want to sink under a mortgage.
Absolutely.
And then over the years, I did a lot of valuation work, which was mortgagee in possession valuations for lenders when they were repossessing assets. So I saw the really cold face of what happens when people are in over their heads with mortgages. You go to people's houses behind the sheriff when they were getting first access, and there'd be half the belongings would be taken. There'd be a pink room and a blue room and a few teddy bears left behind, and people's lives had been turned upside down, and often that came through a lot of devastation, but there was always this element of that they had a lot of debt often that they just couldn't manage, and they didn't have a backup plan either. So it was quite eye-opening to see that.
Yeah, eye-opening is your heart doesn't bleed for them because they were able to get the loan, but something's gone wrong along the way as well, right?
Yeah, and it's often trauma. Someone's been involved in a car accident and can't work, or someone's had
health, employment.
And that's where insurances obviously play a really important role. Not that I can recommend insurances, but it's really important. And having those backup plans, knowing where you can get that cash if you need to, having that savings behind you and that sort of thing. So I started with that property, and it took me a few years to get to the next one because I was, a little bit buried alive in debt at that age too. And then I bought some flats down in Wollongong, 2 on the one title, and strata subdivided and renovated them a few years later and sold them off. And then over time, I've just slowly built my property portfolio. I'm not the 20 properties in 10 years kind of investor. It's a bit too aggressive for me and my strategy.
I just don't think that many investors actually get there.
No, that's true.
And
let alone 200 or 300 like some people do.
Yeah.
I own probably half a dozen properties thereabouts now. I've traded more than that. There's been times I've owned some. I've done gotten development approvals to 4-lot subdivisions and things like that. So I've dabbled in all different asset classes, from development sites to smaller projects, strata, subdivisions, flats, residential. I actually haven't owned any commercial in my own property portfolio. It's probably time I do now. I'm starting to look at that. But
commercial, I feel it's something when you get a little bit more, runs on the board, or you have that level of experience. And I mean, from an equity play, you need probably a little bit more buy-in as well. So it becomes the next logical step once you've kind of...
And it depends what stage of life you're at as well. We're in an accumulation where we want to have strong growth in our asset value. Residential tends to do that time and time again, more so over commercial industrial. Not to say it doesn't grow, but not as aggressively when you juggle the numbers. So when you look at the commercial assets, we're probably ready to draw in a bit more revenue, which is what it does. But we've got a good foundation portfolio. There's a lot of equity in the portfolio now too. And if we came to a position where we didn't have a tenant for 6 months or 8 months, we could draw down that savings or trade out of one of our residentials and drop the mortgage down. We've got more options, I think.
I like what you said about your own portfolio. It's not about the quantity, it's about the quality. And that's something that we're really big advocates for because, you do the numbers and, the top 1% own 6 or more properties. It's not, it's great from an aspirational perspective or great to go, here's what the top 1% are doing. Doesn't necessarily mean that that's the aspiration for every investor. Some need 2 or 3 and they've got good incomes and they've got shares and it becomes part of a truly diversified portfolio. Others, they're capped at how much they can earn. So the passive or trying to get to retirement strategy then means they need to own a couple more properties. And then it's, do I buy 2 at 500 or 1 at $1 million, for example, and some of the crossroads that investors face as well, right?
I've looked at some of these bigger portfolios when the clients have come to us where they've already bought them, whether it be through firms or through their own choices. And sometimes they've got a lot of really rubbish assets. They haven't gone up in value. Some have gone back in value. Some have become nightmares with insurance because they're in flood zones.
Yeah.
I say to people, collecting property for the sake of collecting property is a monopoly game. It's not how you should actually build your strategy.
Well said.
It should be slow and steady and understanding what every property's purpose is for your portfolio and what it's going to help you achieve.
Sage advice. Thanks very much. I want to touch on, and we had a chat just beforehand about the market, and everyone loves to talk about where the market is. You sort out for market commentary as well. And we've had this wonderful bull run, and both our businesses have prospered. A lot of our clients have done very well off the back of this bull run that we've had in property across Australia. As we see, and the tide will shift, we talk about, I say at the moment, increased spending on now international travel or domestic travel. We'll see inflation numbers come out. We'll see rates start to go up. So I guess there's all these little tweaks that are going on behind the scenes, which we haven't had for the last 2.5 years, for example, which will then inadvertently have its own impact on the property market. So it's rare that you have the whole country on fire, but pretty much the whole country has been on fire.
Correct.
So when you're looking now, and you guys are very close to being clients, I'm not trying to hit you up for advice, but more so to say, from your perspective, what does the future for Australian property look like, and how do you see that kind of playing out over the next, say, 6, 12, 18 months?
Yeah, I think there's going to be some real shifts in the property sector. So I've got, my background is I did property economics at UCS, so I've got that understanding of what these levers do when they're pulled. We've seen it in times gone by. So I worked as a valuer during the GFC. I saw exactly what the fallout from that was. I've seen different interest rate environments. Interest rates alone don't control the market. We've seen times where certain markets will grow when interest rates are high while other markets won't, and vice versa. But it's going to be more than interest rates. We're seeing inflation's really kicking in, as you mentioned, and then we've also got, there's not a lot of wage growth has occurred as well. So there's a whole lot of things, and there's a lot of mortgage stress, I think, out there that will start to kick in because we're carrying very high mortgages, very high LVRs. As a country. I tend to think the markets with the higher value points and somewhat by default higher mortgage levels are going to be the hardest hit. So your Sydney's, going into a lot of parts of Melbourne as well, you're getting some very high mortgage values, a couple of interest rate rises, and that will start to really hurt a few people. When people aren't doing their budgets on 2 or 3 interest rate rises and they're carrying a $900,000 mortgage, it's a bit concerning. However, when we look at some of the more affordable markets, so take Adelaide, for example, housing within half an hour of the city centre for suburban family home is $500,000, 600,000 perhaps. Take Perth, similar sort of dynamics, unless you're right on the beachfronts. When you're talking those sort of value points, it's probably going to take a bit more than 1 or 2 interest rate rises to make that market come back in value. Having said that, there's also a lot of infrastructure going in, a lot of job creation. The average wage is quite high. It's being really strongly supported and driven by new job creation as well. And those things will help support those markets. So it's going to be a bit of a 2-speed market. Some are going to get hit harder and quicker. We're already seeing it in Sydney. We're already seeing, the inquiries dropping a little bit from investors. The inquiry from buyers is dropping. Properties are taking longer to sell and people are a bit more price sensitive. So they're the first signs. Which are
very normal market factors, right? Like days on market is more than 3 days. So in the peak of the market, I mean, I went online, I literally was bought on, unseen. And okay, that's a market phenomenon and we definitely can't have that continue. However, this is a normal, and I say to a lot of our prospective buyers, I'm like, you wanted the market to slow down. Now it's the time to get in potentially for that home that you maybe couldn't have afforded or was very competitive in the last 2 years is now becoming a little bit more accessible. And buyers are becoming a little bit more choosy and selective than they
buyers will have more options, which is great for buyers. I see people spend more time buying a new car than they do buying a house.
Preach. Thank you.
They walk in, they go, it's got a kitchen and a bathroom, and then they're negotiating on the front lawn. I think, do you even know where the sun rises or sets with this property? Do you know how many bedrooms it has? They're in there for 5 minutes and they're buying $1 million
Mate, what about the noise, for example, how you live and the functionality of the house? I'm like, I told my brother, I said, bought a brand new car. I said, the amount of tech that's in this car, I said, new homes don't even come out with such great technology. And it feels like it's cars have got so much more technically advanced than maybe houses and homes have. But yeah, it goes
and
to
you
your
probably
point.
test drove the car 3 times before you
did
bought
your
it. It's a
research.
$50,000 purchase or $100,000
You did your research,
purchase.
you watched the YouTube videos, you read the reviews, you
Yeah.
went to the dealership a few times.
But people don't tend to do that with houses because they're moving too quickly. So it's a bit of a scary dynamic and situation, but it is what it is. So buyers should have a bit more choice, which would be amazing.
Yeah.
And I think also it's interesting, some of the indicators, which we touched on earlier when we were chatting before this, agents are starting to call buyers back. So that means they've probably got a bit more time in their hands. They probably think, I need the buyers a bit more. The relationship dynamics changing.
Yeah.
You know, the buyers needed the agent before. Now it might be the other way around. So I think that's going to be a really interesting shift in the market. I don't know that values are going to come back a huge amount though. So what's huge amount? That's just, let's quantify that. Yeah. I've got people that come to me and say, when the market goes down by 50% or when the market goes down by 60%, we've never seen that. We look at all the historical data. Typically, it's a 10 to 20% correction when there is these changes in the economy. So would I expect a 10 to 20% correction this time around? Absolutely. But it's, if you're waiting for the values to halve, I don't think that's going to be the outcome we'll be seeing. Point.
And we're coming off 25% pretty much year on year, right, for a lot of markets. So I'm like, a drop is just going to bring it down. It's not actually going to lose money. It just goes back to a...
It'll just wipe out the last year's growth, which, for buyers isn't too bad. Investors, that's why it also does come down to being strategic about where you invest and not buying at the peak of the market and looking what's going to drive the market for 2 to 3 more years, not 6 more months. Yeah, correct.
And you mentioned one of your roles, the mortgagee in possession. And we'll get this from time to time where clients, and look, I say, there's not really a space that you want to play in necessarily where you're going to look for those bargains, but how do they, just from your own experience and going back in time, how do those properties, when a bank has that hardship conversation with the client, then has to repossess the property, what are the mechanics involved? And because you do see some online and it says it, and some others you wouldn't even know. So
this is something I'm quite passionate about, having worked in that space for a long time, and there's a lot of false information out there. So there's an industry, there's a lady in our industry that's recently just been pulled up by ASIC for saying things that aren't quite true. So anyone following the media might know who I'm referring to. And I used to get really frustrated with some of the things that were put out there because they're not always correct. People tend to believe that you can buy a bargain when it's mortgagee in possession. You can directly approach banks or the owners and buy it when it's in that process. Or, that you actually can chase people around, courtrooms and things like that to get properties off people when they're in financial distress around, bankruptcies and things. The lenders, the banks, have a huge amount of legislation around them on this. So gone are the days where the bank manager used to sell the property to his best mate just to clear the debt and it was a cheap buy. They're not allowed to do that anymore, and it's so heavily regulated.
Yeah, as it should be.
As it should be, because what happens is the property goes, and often, like we said, it comes from trauma. So think about the family who's, the father might have just had a workplace accident, broken his back, never walks again, and these are the people that can't afford their mortgage. So they might have $500,000 debt on a property that should be worth $700,000 or $800,000, right? If they get the true value, market value for the property, they might actually get some money back in their pocket to walk away with, and so they should. They're entitled to it.
Correct.
So the lender has a responsibility, a legal responsibility, to sell the property for market value as effectively as they can. So what they do is they talk to the person. Once it goes into a certain stage of arrears, I think it's about 3 months, or it used to be at the time, might have changed. About 3 months of arrears, they start this conversation and it goes into this process. And the process is that it gets valued. They have to look at all the debt. They usually put a pause on any repayments and start, getting all their funds up with their legal fees, etc. They then go through a process where it gets valued by an independent valuer, which is what I used to do a lot of. Then it has to go to generally public auction. It's rare that it won't go through public auction. It has to then have a lot of reports come back through the valuer and the agent to the bank on about a weekly basis as to how that's going with the campaign. The reason it sells at auction, it stops that thing of, I sold it to my mate sort of stuff happening. And then if it doesn't go for the valuation amount, the reserve price is usually set off that, they'll usually pull it back and not sell it on the day and have it reassessed as to why it may not be achieving that, and it has to be adjusted accordingly. They can't just short sell it. They can't sell it to a friend. They can't sell it outside of that due process, because they'd be in so much trouble if they did. And the owner of the property is entitled to get any surplus funds. Because if they also don't cover their debt position, they'll pursue the owner for that. So, there is there's a very good process around it. in a hot market, they won't sell for a bargain because there'll be multiple buyers after the property.
Yeah.
The ones that sell for bargains usually in regional areas where there isn't a stronger market. So really it might not be a bargain. It might just be what the market is. There's a perception there. They should be achieving market value on every sale, pretty much.
Excellent. No, really informative, because it's one of those topics that you can't really get to the heart of the, and it's not that it's a safely guarded secret, but it's like, where do you go for this type of information? So I want to say thanks. Because a couple of clients have asked us in the past. I said, look, well, it's not really a space that you want to play in and be an ambulance chaser, but necessarily you're buying someone that hasn't been able to afford the property. So again, you may have maintenance issues, upkeep, for example, where the property may be run down as well.
Yeah, often these properties get trashed. Well, not often, sorry, that's probably not a fair statement. Yeah. Sometimes these properties get trashed by past owners because they're in financial distress. Sometimes they get cranky and they break things and, put holes in walls. We've seen some pretty, some people get pretty cranky. Yeah. Understandably, they're under pressure. So people say they've got a bargain, but it might need $50,000 worth of work to bring it back up to standard. Yeah. So, and sometimes they're drug meth labs that have been repossessed and out, crime proceeds. I've had some really interesting stuff where there's been drug labs underneath the house in the basement and you crawl through a hole in the wall to get to this whole other chamber of rooms. But that costs money to remediate and fix those problems, right? So there's often extenuating circumstances that could lead to a lower price, but the buyer has to factor that in. Yeah. And things like remediating meth labs can be hundreds of thousands of dollars. So you've really got to do your due diligence.
That's even before you even try to get a tenant ready, or if you.
And it can take a year. So you can be without rent for a year. Correct. So you've got to do all that due diligence, and the bank sells it like any seller would in the market. So it is up to the buyer to do all their due diligence around those things. Obviously, they have to disclose if there's known factors like that. Yeah. But I also think in Australia, you can make good money off real estate without necessarily profiting off someone else's misery. So if you pay fair money, you pay fair money. It's the circumstances. But to chase it down and try and do it outside of due process, you don't need to do that. It depends what kind of person you are, and that's just not my approach.
Yeah, great sentiment. Kind of get back to the market a little bit. And we moved out of Sydney a little while ago, or 4 years ago, so pre-COVID. And so I guess there's been some regional markets that have really, blossomed off the shift out of metro markets, for example. We're back in Sydney here today, and I've seen in Brisbane and also Melbourne, a lot of CBD workers now start to return to work in some type of hybrid fashion, for example, as well. So do you feel like when you're looking at, say, regional markets that have succeeded off sea changes, tree changes, do you think that can continue, that level of growth, or what does that future look like for some of those markets in your...
I think the regional markets have done better than we expected. They've been the real surprise pack. Yeah. But I do tend to think it's not sustainable. Regional markets don't have the support of the job growth, and what we see is often two-tier markets. You might remember back in probably the 90s and early 2000s, you'd hear a lot about this two-tier market happening on the Gold Coast with units where interstate buyers had come in, buy all these units off the plan, pay higher prices for them, and the locals couldn't support those prices. You actually got two tiers of pricing, one for interstate investors and one that was more locals, and the locals just got left behind. But eventually it corrected, and it corrected quite significantly back to what could be supported by locals. We might have a bit of that phenomenon in the regional markets occurring. So it's being supported by interstate buyers or out-of-area buyers. What happens when people start realising that little farm they bought needs a heap of maintenance? Like they don't run themselves. I come from the country originally. Correct. So, you got to keep mowing those lawns. It's not just a lawnmower, it might be a tractor. And there's a lot of maintenance, fencing and all that sort of jazz, and pumps and dams and whatnot. There will probably become a point where a lot of people will retract out of those areas, especially as flying opens up again.
That's exactly, I was going to go to my next question.
Yeah.
So, keep going.
Once those borders open, and now they are opening, people are looking at overseas holidays more so than the trip down Sussex. And I did this with my mum last night. We went, my mum's elderly, so we sort of want to do a nice big holiday with her. I hope she's not listening. She knows she's elderly. Nice big holiday with her.
Young at heart.
With the grandkids, and we were sort of talking for years about going and doing a big overseas holiday in America. But last night we sat down and went, well, let's stay in Australia because she's getting a bit older and travelling's getting a bit harder for her now. We sort of missed that window. But she also was kind of going, I don't really want to go there, and I've been there and I've done that and I've seen this and I've seen that. We kind of ran out of ideas in Australia that we haven't kind of already done, at least one of us in the family. So then there is now the drive for people to want to get back into holiday mode. And that doesn't always include Mudgee when you've already been to Mudgee 7 times. Mudgee's beautiful. Yes. If you've been there 7 times, you've been there 7 times. So I think I think if any markets are going to see a bigger retraction, I think it will be regional.
Excellent. Which then my next question was, and we've spoken to a few clients about this, going, okay, so we have a fairly similar sentiment. And that's not giving advice, but we're saying what happens if, so playing out a few of these scenarios as well. And it's like, well, I can get Airbnb income, for example, and that then opens up a different can of worms, which is to then manage an Airbnb property, which has high tenant turnover, where every weekend they're coming in and out. Then there's the property management and the maintenance that comes with, high traffic and transient tenants as well. Have you seen from your clients that you've had a chat to, is that something that comes up from time to time going, well, I can Airbnb it, or I do have this option too as well? Because again, international travel versus domestic travel then puts the squeeze on that as well.
Yeah.
Your
So
thoughts?
Airbnb's a business effectively if you're running an Airbnb. It's not necessarily just a property investment strategy. So a couple of things to consider there is there's a lot of tax implications which need to be assessed and considered. There's also no barriers or very low barriers to entry. So, anyone that has a home can make their whole or part of their house an Airbnb. In any market, in any economic sense, if you oversupply a market with a product, what the outcome of that is pricing comes down because there's a lot of supply. So if there's hundreds of sort of hotel or Airbnb options available because everyone jumps in and does it, the price is going to come down. And there's some areas now I'm even seeing when we assess it that the Airbnb price is now becoming lower than the permanent rental price. So that's a really interesting shift.
That's super interesting.
And we're seeing a lot of Airbnb hosts jumping out of it because of that.
Wow.
The other thing to consider, I actually say to people, go onto one of the Airbnb Facebook forums and groups before you do it, because I follow these forums just out of interest, and you see posts on there. They
have the finger on the pulse, right?
Yeah. You see posts on there like, oh, my guest was meant to come at 7:00 yesterday, but their flight was late, they've messaged me, and now they're lost in the countryside, so I've got to go out and find them to show them how to get there. And it's 9:00 at night, and I've got to go get my key from the person who was going to give it to them, or the lockbox is jammed, or whatever.
Yeah.
And they drive around the countryside and find them at 9 p.m. at night, and they're saying, if I don't do it, I won't keep my superhost status, and if I'm not a superhost, I won't get the sort of bookings that I get, and let alone the problems with, oh, I've got this stain on my linen, and I don't know how to get it out, and the guest said it was already there, and I don't think it was, and now I've got to throw really nice sheets in the bin because it's not like, I look at it and think, who wants that stress in their life? Some people love it. It's a hospitality business.
Absolutely.
It's not just a property strategy. So you've got to love that, or you would actually bang your head on a wall. I wouldn't have the patience. I wouldn't be a super host. I'd be like, you're on your own. You're on your own.
You want the place or not? Which one?
Yeah, exactly. You can't break in? Why not? I don't understand. I don't have the keys tonight. I'm out. So, it is a very proactive investment strategy, and you've got to really want to do that. But I do tend to think we'll start to see those rents come back a bit and those vacancies increase, which we're already starting to see in some locations.
Yeah, great. I know a lot of your town, predominantly your team, has a valuer background, right, which comes from a very different, groundwork compared to, say, I bought properties, and I'm certainly not being dismissive. So plenty of buyers agents have, been there, done that, and now want to pass the wisdom on from my own journey.
Correct.
And then you've got, I guess, your legacy is, well, we're property valuers and we can assess a property as well. So I'd say it's a slight advantage because you've got a different perspective as well, right? When you're coming to the table as buyers agents.
Yeah.
So I'm not asking you, it's not tooting your own horn, but just to go, that's a very different perspective because you're looking at a property through the eyes and the lens of a valuer.
Yep. Yeah. And it's a very critical lens. It really is. Sometimes when we bring value, and it is our minimum requirement in our property team is a valuation background and degree. And when we bring values into the team, sometimes they're so critical in properties. I go and see it with them and I say, oh, I'd buy this. Why are you being so hard on it? Like they pick it apart and tear it apart.
Yeah.
We're kind of always looking for reasons what not to buy or why not to buy, because then we know that when the market's a bit softer or when times are a bit harder in the economy and not all ships are rising type things with the waters, will this property still perform? Will it still be desirable? Will it still be a good quality home? And avoiding the things we see go wrong. You might be in a low risk flood zone today and the banks might lend on that today and the insurance company might be fine with that today, but they change their policies all the time. Yes. You know better than I do. Yeah. And then suddenly they're not lending on any flood zones in that area because they got stung in an area and their portfolio decided is it too much risk for that.
Yep.
Same with the insurers. They stop insuring that and then suddenly you've got this problem on your hands. So part of what we look at as values is not just is it a good property or not just pricing, but managing risk. And I think that's probably one thing that we find that a lot of values don't realise when they start in that career. You are actually really managing risk for banks because you're their eyes and ears on the ground. And people say we're conservative, and look, we probably are, let's be honest. But
I'm glad you said it.
But at the end of the day, I would rather, if I know a property's gone through the hands of someone that's critically analysed it, they're not trying to sort of sell anything, and we would pull out more deals than we buy. So, the boys will come back after a run of inspections on the weekend, maybe 25 properties. Most of those, and these ones have already done due diligence on and looked at online and have a good feel for the area, they might only recommend 5 or 6 of those on average. Yeah, okay. And then even after 5 or 6 have been recommended to the clients, then we go in and start doing offers and do more due diligence and start negotiating. We usually might only buy 2 out of, say, 20 odd. So, we're very critical, but I like that approach from our team because we don't have a lot of problems come back. It's very rare that a client comes back and says, we're having trouble with tenants, or we're having this sort of problem, we're having that sort of problem. It's almost never, because we're really picky. Really picky.
And so take me through a couple of those when you look trained eye, or, I'm trying to take all those years of experience, for example, but what's some of those deal breakers and what's some of those deal makers, do you feel?
Yeah, so some of the deal breakers, the list is long. Strap in, the list is long, and it's things that people often don't see, like retaining walls. So you might have some nice looking retaining walls, along the boundary of the property. Yeah. But if they're over 1 metre high and they start to fail, you have to have them engineered. It can be a $30,000 or $40,000 exercise. Yeah, wow. So we won't buy properties that have retaining walls higher than 1 metre. So that rules out a lot of properties in a lot of areas. Things like drainage. If you see a lot of pooling of water around the property, it's probably got drainage issues, and people often don't recognise that either. We're always looking for things like good natural light, good privacy to a property. We don't like these zero boundary type houses built to fences, because tenants will get there and go, hold on, it's not livable. How do I actually live in this home? So we're always looking for that livability functionality factor. Natural light's huge because it's so hard to change. So that's a big one for us, and the privacy factor. Overlays of flood and things like that. So we're always checking for property floods, contamination overlays. Is it in a bushfire zone? Because then if you're in a flame zone, you then have a huge investment to do any renovations, even changing windows out. It's so expensive. So we're looking for these things that are going to minimise that. And how a tenant's going to live there, or how's the future buyer going to live there? Because that's who you want to sell to one day. Yeah. Am I close to transport facilities? But also, sometimes people say, I want to be opposite the train station or within a street of the train station. I don't know if you've noticed, but a lot of kids hang around at train stations and get into trouble. Graffitiing, smoking, drinking. You might not want to be right on the train station.
All the thoroughfare as well, being so close to the train station. Yeah.
You might want to be a couple of streets away, just to give yourself a bit of breathing room.
Distance, but not right at the doorstep.
Yeah, so sometimes you can think things as things that are a positive may actually be a bit of a negative as well. Yeah. We don't buy things with spas and pools, except in Perth, because everything has a pool. If you don't have a pool, you're the odd one out. So it's also understanding what each market needs out of a property and what's desirable in that location. So there's a lot of those things that we look for in that respect. But in terms of the location as well, oversupply is the biggest risk factor to any investment. If you're buying an area that has a huge amount of house and land packages being released, and there's a risk of oversupply or too many units being built and you're looking at a unit, oversupply will put downward pressure on values. Yeah. So that's one that's just a complete deal breaker for us, is what's the supply chain and how do we make sure we're a unique property. Like you take Wollongong, for example, or Newcastle. You've got, especially Wollongong, you've got ocean on one side, you've got mountains on the other, so you've got a limited amount of supply that has to fit between the oceans and the mountains. Yeah. So you've got a unique product in itself that you actually, and everything's a bit unique, that they'll have mountain views or ocean views or something in between. So you've got this uniqueness of product, which then creates much more demand and it limits supply. That's the kind of stuff you want.
Yeah, well said. Well said, perfect. And I guess parting words, if you're speaking to someone new starting out on their journey, what would be kind of bottle up some wisdom and share that? What do you think, Anna?
Yeah, look, there's so many things that I'd love to say to starting out investors, including myself back in the day.
Yeah, great.
I think it's a matter of getting the right team around you. So it may not be a buyer's agent necessarily. It's not about being self-fulfilling here, but you need a really good accountant. You need a really good mortgage broker to sit in your team. And that's probably the starting point. Yeah. You need to crunch your numbers. And don't talk to Brian at the barbecue. Brian doesn't know how to buy investment properties. Brian's probably never invested. Brian has a lot of advice and opinions. Talk to people who have done it. Talk to people who are in the sector professionally, and don't buy in markets that you don't know without getting professional help. We see people jump into a unit off the plan in Brisbane or a property out the back of Ipswich. They've never even been there, buying it off the internet. Don't do that. That's the worst thing you can do. even if you buy in your local area just because you're familiar with it, even though people say don't do that because, you know, you're not diversifying, I'd rather you get a good quality property in an area you know than a bad quality property in an area you don't know.
Yeah,
absolutely, you know, and take a 3 to 5 year view on it. Unless you're a developer, take a 3 to 5 year view. You're not, we've seen a great 12 to 18 months, but in most circumstances, you're not going to turn over $200,000 in 6 to 12 months on a property.
Yeah, correct. So yeah, that market, the expectation is don't expect what it's done. It's going to be a very different market. And I feel like this is going to be that shift where we're seeing the winners from potentially the ones that are going to have to maybe sell, offload, rising rates, for example, pressure on rents. It could be the time that it figures out the great investors from the mediocre as well, isn't it?
Yeah, absolutely. And even the advisors, like in our sector, if you're a buyer's agent, as you say, it's a low barrier to entry. And you would have had to try really hard to get it wrong in the last year. So everyone's getting good results, even if they're actually not that experienced or that good.
Yeah.
So work with people that have experience, from the broking team to the accounting team to your buyer's agent, if that's the path you want to go down. You know, they've almost not been able to get it wrong, but that's not going to be the case forever.
Yeah.
So make sure you're working with people that have a lot of experience and time behind them in the industry.
Yeah, great. Hey, wonderful. Thank you so much. And I really appreciate you jumping on, sharing. This is what great thought leaders do. They want to see investors succeed. It's not about plugging their own business or tooting their own horn. It's going, we just want to see more investors succeed, more Australians that are working hard for their money, but their money needs to work harder for them. And if they win, subsequently our businesses will win, but it's a win-win, and then they're able to help more investors, help their kids have that confidence to get into the market as well. And that's what we're all about. So a lot of our investors, we want to try and create intergenerational wealth through property, because that becomes a game changer as well.
Absolutely.
Excellent. Anna Porter, thank you very much. If you want to connect with Anna and her team from Suburbanite, we'll include their details for socials, website, and reaching out to them if you want to have a chat. But thank you so much again for being part of it. That's a wrap for another episode of the Australian Property Investment Podcast. If you found that helpful, we'd love if you left a comment or a review, or if you had other questions that want to be answered, please feel free to reach out to myself and our team. Until next time, take care.